There's a financial bet in the global markets that has been quietly running for over 30 years. It's a trade so vast, so leveraged, and so deeply embedded in the system that its collapse could trigger a financial crisis, dwarfing anything we've ever seen. And right now, in the fall of 2024, the pin has just been pulled from that grenade. The trade is called the yen carry trade, and for decades it was the financial world's equivalent of a free money machine, pumping trillions of dollars into global assets. But the machine just went into reverse. The Bank of Japan has finally changed the rules, and the unwind has begun. This isn't a theoretical risk anymore. It's a mathematical certainty playing out in real time. This is the story of the biggest financial bet in history, why its collapse is now inevitable, and why the fallout could make 2008 look like a practice run. And it's all happening faster than anyone is prepared for. For over 3 decades, the world's biggest financial players discovered a cheat code for the global economy. It was called the yen carry trade, and the logic was deceptively simple. The Bank of Japan, in a desperate attempt to stimulate its stagnant economy, kept its interest rates pinned at or near 0%. This made borrowing Japanese yen virtually free. So, giant hedge funds, investment banks, and institutions worldwide would borrow colossal sums of yen for next to nothing. Then, they would immediately sell that yen and convert it into currencies like the US dollar or the euro. With those dollars, they would buy higher-yielding assets, things like American stocks, government bonds, corporate debt, and even entire real estate portfolios. The game was to pocket the difference, or the carry, between the near-zero cost of borrowing in yen and the 4%, 5%, or even higher returns they were getting on their US investments. For 30 years, it was a one-way bet, a guaranteed profit engine. It was, in effect, free money, and it fueled a massive leveraged boom in asset prices around the world. The sheer scale of this operation is almost impossible to comprehend. Conservative estimates place the total size of outstanding yen carry trade positions at over $20 trillion. To put that in perspective, that's larger than the entire annual GDP of the United States. This wasn't a niche strategy for a few clever traders. It became the bedrock of global finance. Hedge funds, banks, and sovereign wealth funds weren't just using their own capital. They were leveraged to the hilt, sometimes 10 to 1, 20 to 1, or in extreme cases, even 50 to 1. That means for every $1 of their own money, they had borrowed $50 worth of yen to pour into the markets. This monumental leverage amplified their profits on the way up, but it also created a hidden, systemic risk of catastrophic proportions. For decades, as long as the yen remained weak and Japanese interest rates stayed at zero, the party continued. But everyone knew, deep down, that a party built on a foundation this fragile couldn't last forever. The only question was what would happen when the music stopped. The trigger was finally pulled in July of 2024. After years of holding the line, the Bank of Japan, facing its own crisis of a collapsing currency and runaway import inflation, had no choice. They announced the first meaningful interest rate hike in decades. It was a tiny move in the grand scheme of things, but it was the gunshot that started an avalanche. Suddenly, the entire logic of the carry trade inverted. Borrowing yen was no longer free. Simultaneously, as traders anticipated the end of the free money era, the Japanese yen began to surge in value against the dollar. In just a few weeks, it strengthened by over 10%. For a trader leveraged 20 to 1, a 10% currency move against them isn't just a loss, it's total annihilation. The currency gains that had juiced their profits for years were now wiping them out. The free money machine had slammed into reverse and panic set in. The forced liquidation had begun. The mechanics of the unwind are what make it a self-reinforcing death spiral. To close out a carry trade position, a trader must do the reverse of what they did to open it. They have to sell their assets, their US stocks, their bonds, their real estate, to get US dollars. Then they must use those dollars to buy back the Japanese yen they originally borrowed to repay their loan. But here's the problem. When trillions of dollars of assets are being sold simultaneously to buy yen, it creates a massive, desperate demand for yen. This surge in demand causes the yen's value to skyrocket even further. A rising yen inflicts even more pain on the remaining carry traders, triggering margin calls and forcing them to liquidate their positions as well. This creates even more demand for yen, which pushes the currency higher still. It's a feedback loop from hell, a vicious cycle with no off switch. There are no circuit breakers for a global currency crisis of this magnitude. The selling begets more yen strength, and the yen strength begets more selling. The first casualties appeared almost immediately. In August 2024, the fallout became undeniable. Japan's own stock market, the Nikkei, experienced a violent crash, plunging over 12% in a single trading day, its worst drop since the infamous Black Monday of 1987. The shockwave instantly hit US shores, with markets plunging as the first wave of selling began. The phone started ringing at the most leveraged funds, the dreaded margin calls demanding they post more collateral or be liquidated. When you're facing a margin call of this magnitude, you don't have the luxury of choosing what to sell. You sell everything. You sell your best assets, your worst assets, your winners, your losers, anything that is liquid and can be turned into cash immediately. The indiscriminate forced selling had begun, and the quality of the asset no longer mattered. All that mattered was getting out. This is not just a stock market problem. This is a crisis of everything. The trillions of dollars generated by the yen carry trade didn't just go into the S&P 500. That free money funded everything. It bought up office towers in Manhattan, luxury condos in Miami, and vast portfolios of corporate and government bonds. It financed private equity buyouts and flowed into commodity markets. Because the same source of cheap leverage funded all these different asset classes, they are all inextricably linked. When the carry trade unwinds, it's not a sequential, orderly process. Everything sells off at once. The fundamental principle of modern investing, diversification, completely breaks down. In a systemic deleveraging event, all correlations go to 1.0. Your bonds won't save you from your stock losses because the same hedge fund that is being forced to dump its stocks is also being forced to dump its bonds. There is no safe place to hide when the entire system is being unwound simultaneously. Fast forward to today, and we're diving into the yen carry trade Unwind, which is absolutely massive, like 20 times bigger than that last crisis. Can you even wrap your head around that? It's kind of like watching a slow-motion version of the LTCM crisis unfold, but this time it's zipping by at lightning speed. I mean, think about it. Investors borrowing in yen, where rates are super low, and then putting that cash into higher-yielding assets. It's a recipe for chaos. So, seriously, buckle up. This roller coaster ride is just getting started, and it could get wild. What do you think is coming next? Are we in for a bumpy ride or a smooth landing? Fast forward to today, and we're diving into the yen carry trade Unwind, which is absolutely massive, like 20 times bigger than that last crisis. Can you even wrap your head around that? It's kind of like watching a slow-motion version of the LTCM crisis unfold, but this time it's zipping by at lightning speed. I mean, think about it. Investors borrowing in yen, where rates are super low, and then putting that cash into higher-yielding assets. It's a recipe for chaos. So, seriously, buckle up. This roller coaster ride is just getting started, and it could get wild. What do you think is coming next? Are we in for a bumpy ride or a smooth landing? Fast forward to today, and we're diving into the yen carry trade Unwind, which is absolutely massive, like 20 times bigger than that last crisis. Can you even wrap your head around that? It's kind of like watching a slow-motion version of the LTCM crisis unfold, but this time it's zipping by at lightning speed. I mean, think about it. Investors borrowing in yen, where rates are super low, and then putting that cash into higher-yielding assets. It's a recipe for chaos. So, seriously, buckle up. This roller coaster ride is just getting started, and it could get wild. What do you think is coming next? Are we in for a bumpy ride or a smooth landing? Fast forward to today, and wow, we're diving into the yen carry trade Unwind, which is mind-blowingly estimated to be at least 20 times bigger than that infamous crisis back in the day. Can you even wrap your head around that? It feels like we're witnessing a slow-motion version of the LTCM crisis, but this time it's unfolding at lightning speed, right? Seriously, you might want to buckle up because this roller coaster ride is just getting started, and it could get super wild. Think about it. When investors start pulling out, it could shake up markets globally, affecting everything from stocks to bonds. So, what do you think is coming next? Are we in for a bumpy ride Or do you see a silver lining? Let's chat about it.